Market internals analysis. Think of market internals as gauges on a dashboard that are measuring historical extremes of breadth and sentiment. Market internals are not price indicators like stochastics, RSI, and MACD, which means you're not looking at a derivative of price which you're already viewing in stocks and indices. Internals are a broad measure of market strength, or the lack thereof, and how traders feel about the market. When internals are aligned with price patterns, the odds are higher that pattern will follow through, as suggested. Without internals, you're only looking at part of the information needed to make an informed decision. In this section, we'll cover end-of-day internals for swing and core trading, and short-term internals for intraday trading. Sentiment gauges measure the level of bullishness or bearishness and act as contrarian indicators at extremes. Extremes being the key word. We need historical measurements of what is extreme and not assume that the market has moved too high or too low just based on price action. We'll pay attention to the trend as well as support and resistance, and the levels that we'll pay attention to will have neutral, above average, and climactic levels. Realize that these levels of importance will change over time. We'll update that through backtesting. As different market environments come and go, we'll see that bullish sentiment becomes more extreme in bull markets, and bearish sentiment becomes more extreme in bear markets. That said, human nature never changes, and these indicators continue to work over time. Price will be the final trade determinant. We use charting techniques or candle patterns, moving averages, support, resistance, and retracements for making our trading decisions. Sentiment indicators are one step in the process of understanding what's happening in the market at that moment and when it's reaching its probable turning point. Sentiment indicators will be focused on the CBOE equity put call ratio, the NYSE volatility index, the NASDAQ volatility index, and the bullish and bearish percent. The market indicators will be the NYSE tick and trend, the NASDAQ tick and trend, and the S&P and NDX futures. A put call ratio divides the total number of puts being traded by the total number of calls. The higher the level of the ratio, the more bearish traders are becoming and the greater likelihood of a market bottom. The more bullish they are, the lower it'll move, and as it reaches an extreme, the greater the likelihood of a market top. So when they're overly optimistic buying calls or overly pessimistic buying puts, it acts as a contrarian indicator and suggests a reversal. Now, put call ratios, just like any other market internal, tell us the probability that change is increasing, but we use price to determine when our action points are at hand. Now, historical extreme levels for the equity put call ratio becomes bearish when it moves above 0.8, which is bullish. Now, on very extreme bearish markets, we've seen the equity put call ratio move to levels of actually 1, but that's a very extreme reading. Extremely bullish readings occur when the equity put call ratio moves below 0.5. We're also going to monitor this equity put call ratio on a 5 and 10 day moving average basis for swing trading purposes. And as the market environment changes, we'll adjust the levels. We can chart the put call ratio like in this slide, or we can watch it in a minder. What we're focused on here is where it closes at the end of the day. Extreme daily closes typically signal a turn in 1 to 2 days, whereas a close less than 0.50 suggests a reversal in the market to pull back, whereas a close greater than 0.80, where traders are buying a lot of puts over calls, suggests a bottom. At times, you will not get a close in either direction for quite some time. For example, if the market was declining for an extended period of time, and then there was a close on a day where they closed above 0.80 or higher, that could signal a market bottom. We want to pay attention to where this closes at the end of each day and if it's at an extreme. If it closes in between, we're not concerned with that, as we will be looking at moving averages of the closing. Smoothing out the closing equity put call ratio at a 5 and 10 period moving average, we'll use this as a sentiment oscillator in a sense to tell us when traders are becoming excessively bearish, buying too many puts, or they're becoming excessively bullish, buying too many calls. We're setting up a chart like this marking off the areas of bearish sentiment at 0.80 and above, and bullish sentiment in the area of 0.50. This will tell us when traders are becoming excessive in sentiment and when to think from a contrarian point of view. Now, in bullish environments, these bearish levels may not get as extreme, and in bearish environments, the bullish levels may not get extreme, which means at times we may have to adjust the areas where we see the turning points occurring. The volatility index, or the VIX as it's referred to, is the implied volatility of S&P and NDX call and put options. This tells us the expected future volatility of the market and also market reversal points. We can assess how traders are reacting to the market and what their expectations are. If they're willing to pay higher premiums for puts during a market sell-off, the VIX will rise. This confirms fear in anticipation of lower prices. We'll also be looking for prior turning points in the VIX, as when the VIX rises to an extreme level, it tells us where traders are willing to pay an excessive amount of premium for those options and likely to be on the wrong side. If the VIX does not rise during a declining market, traders are likely complacent and the odds of further downside prices are to come. As the market is rising, the VIX typically falls as traders anticipate lower volatility. The prior price levels and patterns are going to be used as a guide for market turning points as we see them in the VIX. Market environments change, and adjusting levels of extremes in the volatility index is needed. As you can see on this chart, volatility index has changed levels over the years. And back in the early 90s, the mid 90s, it oscillated between around 10 and the 18 level, and then in the latter part of the 90s and early 2000s, between 20, the 20 level was a low level, and moving up toward 35 to 45 was at high extremes. Later on, after 2003, as the market bottomed and moved up from there, the volatility index returned to lower levels and trended down. As the volatility index forms support levels and resistance levels, it'll give us suggested turning points of the market. As the VIX moves up to higher levels and forms a bearish change of the guard, it'll signal a move lower in the VIX and a move higher in the market. As it comes down to support levels and forms a bullish change of the guard and or bottoming tail, that'll suggest a move up in the VIX and a move down in the market. And as it moves up to extremes, we can look at the candle patterns that it forms, like in this example, a doji bar after an extreme high level, signaling a strong momentum in the VIX, and a move down in the VIX, and a move up in the market at that time. The VIX gives us value information when it's trending, so in this example, the VIX was trending down, which tells us the market should continue to move up. But it may not be as helpful for turning points, meaning when it's going sideways or in a range, it's easier to see the turning points in the buy signals as we see in this chart. Now as I said, we're interpreting the VIX like every other market or every other chart, and that it's about supply and demand. And when the VIX rallies up to an area of resistance, and you get a change of the guard, or a type of PSS, it's going to be a buy signal signaling that the market should move up from that point. You can also use the VIX as reference points for turning points in the market. So what we see here is the VIX was moving up to an area of a prior high. So just like we would interpret in a price chart of a stock, when those prices come up to the area of a prior high, it suggests a reversal. What we're seeing happening in the S&P 500 at that time is it was actually breaking down from a consolidation, and you see the wide range bar breaking down under the lows. This suggesting a continuation to the downside. But with the VIX up near prior high, that was suggestive of a market bottom. We want to combine the messages in the VIX with the messages in the general market. Now on the right side of the chart, we see that the S&P 500 had rallied up from that low and then moved up to an area of resistance. And while it was moving up at that time, it was suggesting that it would move higher as the trend was up. Notice at the top of that move, at the top of the red oval circular part there, the red topping tail bar, right at the top there, that little red chaining of the guard, was a little breakout failure that occurred at that time. And then prices began to decline. Now, when they began to decline, they hadn't broken any support yet, but as the market begins to move down, we want to see the volatility index begin to move up. That just tells us that traders are fearful of the market. We want to see that inverse relationship occur even with the slightest bit of profit taking and beginning of sell-off. If it doesn't move up while the market begins to move down, it suggests that the market will continue to move down until that volatility index starts moving up. Also, notice at the bottom of the chart of the S&P, the bottoming tails in the W pattern that had formed down there as the VIX had moved up near the area of the prior highs and extremes in the 34 to 36 level. Now we're going to look at an intraday market internal. It's called the tick indicator. This tells us the number of stocks that are trading on an uptick at the time versus a downtick. So those stocks that are trading on upticks are subtracted from those that are trading on downticks. They give us the value of the tick indicator. We're going to use this to determine when the market may change direction intraday by noting its areas of support and resistance that it forms. So it's going to give us an indication of the broad market support or resistance at that time. Those stocks that are trading on upticks at the time, the majority of strong ones that started trading on downticks at that time, will form an area of resistance that we'll see in the VIX. And those that are the weakest, that were trading on downticks at the time and began ticking up, will form areas of support in the VIX that we'll use. Again, so those prior highs and lows of support and resistance are going to be for the general market. Extreme readings are plus 1,000 and minus 1,000. Now, these are historic readings. In bullish market environments, the tick can go beyond plus 1,000 and often does. And in bearish ones, it can go well beyond minus 1,000. In the most bearish market environments, we've seen readings of minus 1,500, 1,800, and even 2,000. But these historical extremes, plus and minus 1,000, suggest short-term turning points in the market. And you'll want to set alerts at these levels so your computer can monitor them for you. Trading ranges above zero will give us a bullish bias, and when we see trading ranges below zero, meaning the tick is spending the majority of its time below the zero level, it'll give us a bearish bias. Here's an example where the tick was in a range on this particular day, and we use it to determine market strength and directional changes. And when the readings were above zero, there were more stocks trading on upticks, and we favor longs at that time. We'll also use the prior highs and lows as turning points of support and resistance. Now, as the tick moved up to that area of the plus 500 level, we look for the market to begin to pull back. And when the tick moved down on these particular times to the area of the minus 3 to 400 level, where it had turned up before, we look at that as an area of broad market support. Now, on this particular day, we see that there were no extreme readings in the tick, meaning it did not go up to plus 1,000 or minus 1,000. It did not even get to plus 800 or minus 800. So when you have days where it's oscillating above and below the zero line and you don't have any extreme readings, it's really an indecisive type of market day. And you want to keep that in mind when you're looking for longs and you see that you don't have an extremely strong type of market day, or you're looking for shorts and you don't have an extremely weak type of market day. Again, a tick oscillating above and below the zero line and not going to extremes is an indecisive type of a market day. Here we have a bearish market day and a bullish market day. Bearish market days spend the majority of their time with the tick oscillating below the zero line. Note the accelerated move down toward the minus 1,000 level. This indicates panic and the likelihood of a bounce in the market at that time. As the tick drops down to the minus 1,000 level, the stocks that are moving down should begin to stabilize and then try and bounce higher. Those that do not move higher, when the tick moves higher, will be showing relative weakness, and we'll be covering that in another chapter. Now, you've seen on this example here, I've shown you the tick in a candlestick format. It's not necessary to look at it in this way, and I'll warn you against analyzing candlestick patterns in the tick. While they can provide some value, you do not want to overanalyze what's happening by analyzing the tick in these candles. Just take note of the area that it's spending the majority of its time in and whether it's moving into an extreme level. On the bullish market day, you see it spent the majority of its time above the zero line, and while you have many overlapping candles, that's not our concern. What we're focused on here is where it's spending the majority of its time and whether it is going to extremes. And on a bullish market day, you want to see the tick going to extremes. If not at plus 1,000, close to plus 1,000. This tells us that there are many stocks that are trading on upticks, and it's confirmation of an uptrending market. Now, you don't want to short when the tick goes to a plus 1,000 reading on a bullish market day. What you want to do is wait for it to pull back toward the zero line or a prior reference point of support in the tick, and then look for the stocks that you're focused on to see how they reacted to that pullback in the tick, and then look for entry points as the tick is pulled back to its support. On the left side of our chart, we can see as prices were moving down and made it a lower low, the tick also made a lower low. This is confirmation. As prices continued to move down, we saw lower ticks, and then eventually at the low, we see as prices made a lower low, the ticks made a higher low. This tells us that there was internal strength within the market, and some stocks were not moving down as they were before. This type of divergence between the tick and prices, in this case we're looking at a market index, is signaling the potential for a market bottom here. As prices did move up toward the area of the prior high and made a higher high, the ticks also made a higher high. That was confirmation. Now, as prices pulled back, which is marked HH or higher high, notice that when they pulled back at that time, when the ticks moved down toward that bottom blue line, mentioned that the prices then moved sideways and consolidated as the ticks moved down. But at that time, this price chart was showing relative strength to the tick and was a bullish sign for prices. And as prices continued to move up from there, the ticks moved up toward highs and confirmed the move higher. So we're constantly looking for confirmation between price moves and the tick and divergences between price moves and the tick. The trend indicator gives us our overall market bias. By dividing advancing issues into declining issues, and then advancing volume into declining volume, and then taking one ratio and dividing it into another, it tells us how much volume is associated with those advancers and how much volume is associated with the decliners. When there's reading above 1, it indicates more volume associated with the declining stocks, which is bearish, and readings below 1 indicating more volume is associated with the advancing stocks, which is bullish. Now, more than the absolute value, we want to pay attention to the trend. While the trend is rising, this is bearish as volume is rising into declining stocks. And when the trend is declining, a bullish trend, it tells us that more volume is beginning to be associated with advancing stocks. But we also want to pay attention to extreme readings, which can act as contrarian indicators. When the trend moves above 1.5 to 2 or greater, it tells us that there's an overwhelming amount of volume that's associated with those decliners and is the potential for a market reversal. When it moves below 0.35, an extreme amount of volume associated with the advancers, it tells us that there's a potential for a market to start to pull back. We're also going to follow the 5 and 10-day moving averages of the closing trend for overbought and oversold readings for our swing and core trading. The trend will be used to determine who's actually in control of the market. As you can see in this example, on the left side of the slide, buyers were in control. The trend was under 1, more volume associated with advancers, and was declining, which means that more and more volume was beginning to go into advancing stocks, and that was becoming even more bullish on the day. That said, it began to move up. And as it began to move up toward the 1 level, right, although 1 tells us that there's more volume associated with advancers, that volume was beginning to diminish, and there was more volume beginning to move into declining stocks. So as the trend continued higher and above 1, the day was becoming more and more bearish. Here's a perfect example why we say the trend is more important than the absolute value. Earlier in the day, the trend was at a low level in basing. And when it's at a low level in basing, that's very bullish, so you don't want to trade against that indication just because it's at a low level. A trend at a low level like this and going sideways is bullish, and you want to continue to look for long trades. But when it begins to rise, it tells you that the volume is beginning to move into those declining stocks. So as it was rising higher and higher, the day was becoming more bearish, and by the time it had gotten to 1, the majority of the selling was actually done. So while we want to pay attention to the absolute level, it's the trend that's most important. To clarify the trend, we'll apply a 20-period moving average to our 5-minute chart. Just like applying a 20 MA to a stock, this tells us the direction of prices more rapidly, or it becomes a visual aid to determine the trend. While we can see this without the moving average, it gives us a visual aid that allows us to see this more quickly. So while the trend moves under the 20 MA, the market is becoming more bullish as it's trending down. If the trend moves above its 20 MA, the market is becoming more bearish. Then see what level it's at. So if the trend is moving up from a lower level, say 0.40, 0.50 toward 0.1, it's not going to be as bearish as a trend turning up from a level of, say, 0.90 toward a level of 1.3. Here's an example of a day where the majority of stocks open lower for trading. The trend tells us that this gap down was associated with panic selling and a probable reversal. At a level of 3.2 at the open, it does suggest that the trend is likely to decline. As the trend began to decline toward the level of 1, it was becoming more and more bullish as more volume was beginning to be associated with more and more advancing stocks. And by the time the trend fell to 1, the majority of gains had been done for the day. As the slide says, do not fight this trend. The futures were trending above the 20 MA and making higher highs and higher lows. The tick was oscillating above the 0 line and moving to extremes. And when we say extremes, we say we want to see that the trend is moving above at least plus to 5,600 and moving up toward plus 1,000. The trend was trending below its 20 MA, which tells us more and more volume was beginning to be associated with advancing stocks. One thing that would have made this even more bullish than it was on this particular day would have been if the trend was trending below its 20 MA and below the level of 1. By smoothing the closing trend with a 5 and 10-day moving average, it will provide us with historical reference points of extreme buying or selling pressure, or the level of volume associated with market lows and highs. When you see the trend rising in a rising market, this suggests selling into strength. The trend should do just the opposite in a rising market. It should be declining as more volume is moving into advancing stocks. So when the trend is rising, while the market is rising, again, it tells you that there is selling into strength, or more volume is going into the decliners as the market is rising. As always, use the market indices and or the stocks patterns as indications of the actual turn, not the market internal. Let's look at the corresponding dates on the next slide. Here we see the dates that corresponded with the prior slide. You can see on 10/31, the trend marked the bottom. As prices proceeded up from that point, notice how prices moved sideways at the top of the large green bar. Note that the tails, while dropping above and below the high and low of that bar, the candle body stayed right in the context of the prevailing trend. As prices moved up from there, and eventually the trend marked an overbought level at 11.19, there was a correction into 12.03, marking a low, and then a subsequent high on 12.06. Also notice the rally into the prior high where the trend was rising. So this was bearish and selling into strength at that time. Setting up an end-of-day market internals page like this will speed up your analysis at night. Noting the volatility indexes support and resistance and their trends. Closing put-call ratio, the 5 and 10 period moving average of the put-call ratio, and the 5 and 10 period moving averages of the NYSE and the NASDAQ trend. We see here on this particular day with the stars, you see that the volatility index was retesting a prior high resistance, which would suggest that the market would be at a bottom. The closing put-call ratio was closing at an extreme over several days, so sentiment was bearish or at an extreme. The 5 MA of the put-call ratio had closed at an extreme, and the 5 and 10 period moving averages of the NYSE and the NASDAQ trend were at extremes. So all market internals were aligned, suggesting that the market would be at a bottom. Now look for a pattern in stocks and indices suggesting the same. These are the main sectors to use as additional filters to follow the patterns in the equity futures and or cash indices. When these sectors, banking, brokers, and transports, are in alignment with the Dow and the S&P, the odds are good the patterns will follow through. When they're diverging, meaning the Dow or S&P futures are moving up, and these sectors are not moving up with them, it can be a warning sign of a reversal. When the NASDAQ sectors are in alignment, either bullish or bearish, with the NASDAQ or Russell, odds are that these patterns will follow through as well. We're constantly looking for confirmation of these sectors with broader market indices or divergences. Reversal periods are when most stocks and indices often change direction. The morning reversal periods have been the most reliable and consistent over the years. Around 10 o'clock and around 10:30 each day, stocks and market indices often change direction. The midday, or what we call the midday doldrums, is often a time when to be out of the market. But on trendless mornings, where the markets have not moved in either direction very much, these are times when reversals can happen and markets can actually start moving. Later in the day, typically around 3 o'clock or 3:30, is also times to pay attention and be alert for turning points in the market. Here's an example of a stock changing direction at the various reversal times. Reversal times keep you alert to possible trend change. Price confirmation is always the ultimate indication of change of course. We could have seen each of these turning points with our other techniques, candlestick patterns, support, resistance, and so on, but reversal times keep us alert of that potential change coming. Steady morning trends typically end after 11 o'clock. Sometimes it'll be 12 o'clock or 12:30, even as late as 1 o'clock at times. Keep in mind that steady trends that have continued throughout the early morning into the midday doldrums typically end at that time. So in this case, shorting a new low at this time of the day often results in a poor odds trade. Same would be said if prices were trending higher throughout the morning and then made a new high during this time of the day. Lastly, we have sentiment surveys. The one to pay attention to is the AAII Index, or American Association of Individual Investors. This is the one that's been most helpful and consistent over the years of displaying the excessive amount of sentiment, either bullish or bearish. You can go to their websites. This information is updated on Wednesdays at AAII.com. 60% bulls and 21% bears is an extreme. So checking these on a weekly basis will keep you in touch with the majority are thinking. With all market internals, they're meant to be used in combination with each other. And when you're looking at, for example, the tick during the day, if the tick is high, look for the trend to be declining. If on the end of the day, if you see the put-call ratios have reached a high extreme, see if the trend moving averages have also reached a high extreme. And market internals are meant to be used in combination with each other, not as standalone gauges in of themselves. This is how they'll be the most reliable, when they're all in agreement.